Hey everyone, welcome back to another video. In this video, I'm going to be looking into Charlie Munger's position in Alibaba, and then I'm also going to be reviewing their financial results for the second quarter of 2022, and then I'm going to end the video off by figuring out what the intrinsic value per share of Alibaba's stock price could be, so we can know if buying into the stock price at the current share price of about $65 per share would be a good idea from a value investing perspective. So thanks in advance for leaving a like on this video. Really helps this video get recommended to more people on YouTube. So thanks for that. And let's get right into it. So we can see right here that the S&P 500 is down about 20% and Alibaba is down about 60% in the same year. So they're severely underperforming the market at the moment. And so if we look at Charlie Munger's position in Alibaba, we can see he's currently invested in 5 stocks right here. And Alibaba makes up about 14% of his total portfolio. He has about 300,000 shares at about $79 per share for a total of about $24 million invested in Alibaba. And we can see that all of his positions are in the green with the exception of Alibaba, which is down about 20%. And he's actually been adding to this position for a little bit over a year now. And it seems like he isn't really worried about the current trajectory of Alibaba's stock price. And so I pulled up a couple of articles here just to see what the overall market thinks about Charlie Munger's position, as well as the risks to Alibaba's stock and China's economy as a whole. And this article points out that Charlie Munger doesn't really seem that worried about a potential delisting for the American depository receipts for Alibaba. And obviously, with China's economy being heavily regulated by the CCP, it's really uncertain whether or not China is going to delist some of these companies or whether or not America is going to delist some of these companies from American stock exchanges. And if that were to happen, then that would obviously negatively affect a lot of these stock prices for these Chinese companies. And so we can see right here, they point out Charlie Munger isn't worried about delisting. And ever since the news came out about the potential delisting of all of these Chinese stocks, he hasn't even sold a single share of his 300,000 shares of Alibaba, now valued at about $27 million, as we saw. So he doesn't really seem that worried about it, which might make sense because one of the main ideas, I guess you could say, or philosophies that Charlie Munger and Warren Buffett tend to stick by is to be greedy when others are fearful and fearful when others are greedy. But that being said, we can see right here that this article points out something a little bit interesting about China's economy as a whole, and that's that Yuan devaluation is also a major concern when it comes to the effect it might have on the future of Alibaba's stock price. So it's not just about Alibaba being delisted, but also about China's economy potentially getting worse from here on out. And they point out that if the Chinese currency continues to devalue, then Alibaba's revenue growth and profit numbers would drop due to the foreign currency translation adjustment when their financial statements are translating their revenues and profits from Chinese currency into US dollars if the yuan actually devalues against the US dollar. So that would not be good for Alibaba's company or their stock price. And so we can see right here, we see some of that in their financial statements. They're comparing the results of the second quarter of 2021 to 2022, and then they're also translating the results of the second quarter of 2022 into US dollars. And we can see that the year-over-year growth for Alibaba from 2021 to 2022 for their revenue has actually been 0%. They've mainly stayed at around $30 million year over year. And I know it doesn't say it here, but of this $30 million of revenue, $21 million of this was their commerce segment revenue, and then about $2.6 million of it was their cloud segment revenue. And their commerce segment revenue, that's their big website, that's sort of like the Chinese version of Amazon, that decreased by about 1%, and then their cloud segment revenue increased by about 10%. So the cloud segment revenue increase actually offset the decrease from the commerce segment revenue, and that's what ended up resulting in the 0% year-over-year growth for Alibaba for their cloud segment and commerce segment revenue. And so if we scroll down here, we can see that their net income actually decreased by about 53% year over year. So that's a substantial decrease to about $3.03 million. So obviously, if their cost of revenues are increasing, as we can see here, but their revenue is staying exactly the same, and they also have some other line items where they're not experiencing as much of a return from interest and investment income, that's obviously going to result in much lower net income year over year. And so if we scroll down and look at their balance sheet, they're doing a bit of the same thing, comparing their balance sheet results from Yuan to US dollars, we can see that their total assets at the moment come out to be about $255 billion worth of total assets. And the majority of Alibaba's business is financed by equity as opposed to liabilities. They have about $91 billion worth of total liabilities and $162 million worth, or $1 billion worth of total equity. And then lastly, in their cash flow statement, we can see that they don't really go into detail providing too many line items for their cash flow statement, but they do produce the net results. They show us the net results for their operating, financing, and investing activities. And so we can see that they had a net cash inflow from their operating activities of about $5 billion. And then on top of that, we can see they invested pretty heavily, investing about $4 billion in investing activities like buying marketable securities and things like that. And they also had a net cash used in financing activities of about $3.1 billion. And of this $3.1 billion, they actually ended up repurchasing about $3.5 billion worth of American depositary receipts right here. And so that ended up equating to about $308.7 million of ordinary shares for Alibaba. So that could indicate that the management for Alibaba believes that their own stock is currently undervalued, and so they're trying to scoop up shares of their own company while their stock price is trading at such a low number. And so now if we look into this discounted cash flow model that I made for Alibaba, basically Yahoo Finance is estimating that Alibaba is going to grow at an extremely conservative growth rate of pretty much less than 1% for the next decade or so. They had about $13.9 billion of free cash flow in 2021, and they currently have a net cash position on their balance sheet after subtracting all of their debt of about $279 billion. That's a ton of cash. And then they have about 2.65 billion shares outstanding. And so with these metrics in mind, at such a conservative growth rate of less than 1%, it looks like Alibaba's intrinsic value per share is estimated to be about $159 per share with a 50% margin of safety of $79 per share. And so even with that extremely conservative growth rate, Alibaba is trading below a 50% margin of safety relative to their intrinsic value per share at the moment. So that could be one of the reasons why Charlie Munger is so set on buying low into Alibaba's stock price at the moment and then waiting for a potential recovery to their all-time highs of around $300 per share. But on top of that, I also did a competitor analysis just so we could see where Alibaba ranks up against the rest of the companies that they're competing with in their industry. I mainly used American companies here like Amazon, Walmart, and eBay, which have similar business models to Alibaba. And we can see that when we're comparing these companies against each other, that Alibaba has basically the third best gross profit margin out of the three companies, with eBay coming out on top. But they have the highest net profit margin out of all four of the companies, so they have much lower cost of revenues essentially in comparison to the rest of the four companies on this list. And then lastly, for their return on assets, they're around middle of the pack. They come in third place as well. And so we can see from a competitor analysis for their business efficiency ratios from their financial statements, it looks like they're doing decent. They're not really blowing out the rest of the competition, but they are keeping up with the rest of the competition in this industry. And then from an intrinsic value perspective, we can see that they're trading way below intrinsic value per share at the moment, according to these very conservative growth rates for Alibaba. But that being said, it might be actually not conservative to say that Alibaba would grow in the future at all, considering the fact that when we looked at their financial statements, their revenues grew at 0% year over year. So it might actually be a bit too progressive or liberal of an estimation to say that Alibaba is going to grow at all over the next decade, especially considering how strict the CCP is being with tech companies and their growth in China at the moment. So very difficult to tell what's going to happen with Alibaba in the future, but it seems like Charlie Munger is dead set on holding on to his 300,000 shares of Alibaba in the hopes of a recovery so that he can see a return on his investment. But I'd love to know what everyone watching this video thinks about Alibaba. Is it a buy or a sell right now? Definitely let me know in the comment section down below if you guys think this is a red flag or a really good opportunity to get a large return on investment. So leave a like on the video, subscribe to the channel, and I'll see everyone in the next one.